Don Kaufman reminding each and every one of you, Guide to Surviving and Thriving in Extreme Volatility. Our class is Saturday, March 7th, 10 a.m. to 1 p.m. Eastern Standard Time. Please go now to TheoTrade.com/risk. Again, it's TheoTrade.com/risk to enroll for that class now. The course will be archived immediately following the presentation. Now, that course is going to include a full 3 months access to everything we do here at TheoTrade. Again, this course is designed to walk you through all the aspects, okay, first of survival in the midst of volatility, but more importantly, how to turn that around and thrive in the midst of volatility. Click Add to Cart right now. Of course, come over here. It is $297. It's not a membership. It includes a full 3 months of access to everything we do here at TheoTrade. In addition, when I say everything we do here at TheoTrade, it's going to give you access to 88 on-demand courses, okay? Including, of course, the class coming up that is live this Saturday, March 7th, 10 a.m. Eastern Time, right? We also give you access to our live trading room, which is streaming live 6 hours per day. Everything is archived. We give you every single proprietary study and scan that we have available. As I said, access to all of our courses. We do trade alerts via text message, okay, and push notification. Of course, we're also going to give you access to the TheoTrade mobile application for iOS and Android, so you can download many of these archives and watch them at your leisure, or even watch them at 2 or 3 times the speed. All of this is $297. Click Add to Cart right now. That includes 3-month access. This is not a membership. You will not be billed after that 3 months. Again, please go now to TheoTrade.com/risk. Now, let's get to this weekend's update. Welcome to TheoTrade. This is Don Kaufman. It's March 6th, 2020, and you are watching the TheoTrade Weekend Update. Markets infected with extreme volatility. I mean, come on. That's all we're hearing right now is about the coronavirus infection. We've got nothing more than volatility hitting the marketplace and continuing to perpetuate. All right, the fear is not only the coronavirus, but the volatility has taken on a life of its own. Hence, we are infected with extreme volatility. But I pause for a second. And, when we talk a little bit about volatility in the marketplace, and obviously, I'm a fan of volatility. I say, is volatility. Are we having fun yet? This, as a trader, is what you live for. For years, we wait for this kind of volatility. And I think that these markets are so interpreted that many traders are typically running, for the hills when they start to see like the onset of volatility. The technology isn't working. It goes on and on and on, all the excuses around volatility. But the bottom line about volatility, survival first. Okay? You have to be able to survive the onset of volatility. You have to be intimately comfortable with your risk. Because if you can't handle the risks that you have on, you have zero chance of going into the onslaught of volatility and actually creating opportunity out of that volatility. And I'm going to tell you right now, people, that's exactly where we are right here, right now. This entire week, listen, we haven't forged, and what you're looking at on the chart right now, okay, this happens to be none other than a 30-day, 1 hour. We haven't forged any lower territory. This lower territory, okay, that was actually made, last week all the way down here to the 28.53. We've actually bounced back up, and all we're doing at this point is channeling back and forth. And again, that is what creates immense opportunity on an intraday basis, on a day-to-day basis, on a week-to-week basis, on a premium selling basis. This is volatility, and yeah, we are enjoying it because it has been docile out there for literally years. With that, let's start digging a bit more into the charts and really some of the opportunities. One of the first things that I want to enunciate for a moment here is about gravity points. they have just paved a magnificent path for us in the midst of this volatility. They're giving us an opportunity to be able to navigate the vol much more readily. And these gravity points, and I'm giving them to you right here, right now. They're on your screen. 29.83, 29.11, 28.42, 28.11, 27.31, 26.82, 26.26, and 25.75. Stop right there. They're just lines across the screen. Where do they actually come from? Me. What these gravity points are is nothing more than painstaking intraday analysis. Trading firms, proprietary trading firms, market making firms, banks, okay? They trade a substantial amount. Most of them actually use algorithms in order to hedge off existing positions. Now, in the midst of them hedging off positions, we kind of term a seam inside of the risk. A seam inside of the risk. And I'll give you a quick example here. For example, could be right there at 29.11. What that seam really amounts to, okay, it's almost like a delta neutral area. It's actually a seam between the delta, okay, sometimes of multiple trading firms, of two major trading firms, and what it creates are literally pause points in the midst of volatility. And the reason we love these gravity points is we'll then ping back and forth, okay, from those gravity points. Now, the gravity points themselves, although they pertain to the S&P E-mini futures, and by the way, the gravity points are only found inside of the S&P futures, so they pertain to the S&P futures, but I don't fish them out just using futures contracts. You got to look at volatility contracts. You got to look at individual equities. Okay, this is about aggregate position risk, the use of algorithms to manage that risk, okay, and little windows, little seams open up in there. Let me show you why I'm so adamant about using these right here, right now. If you haven't ever looked at the gravity points, here, let's take it down initially to a 30-day 1 hour. On a 30-day 1 hour, you can actually see that these gravity points we've actually been channeling, okay, back and forth. We did break to the upside, and frankly, I don't have any gravity points up here. I just don't. Okay, might they exist? Maybe. I haven't been able to fish them out though yet. No question about it though. Here at 29.83, we're home. It's one of our key kind of gravity points. And when I say we're home, what does it look like all the way down to an intraday chart? Intraday, 1 day, 1 minute. Okay, this is today's trade. Now, this is a line at 29.83. And you're going to probably question, when did he write that? When did he come up with that thing? Yeah, I have a date for you because here's the inception point of this gravity point. Okay, of 29.83, I was able to fish that one out. There it is, the start date, September 15th of 2019. Okay, other gravity points here, you can go back in time. You can see videos literally from years ago. We're actually talking about these specific levels. Again, seams in the risk. Okay, now, if you take a look at them on an intraday basis, when I say we're pinging back and forth, here's overnight trade. We actually caught one of the gravity points and we channel back and forth. Breaking off the gravity point typically entails heading to what? The next gravity point down. So to use these things, it's huge. It's just absolutely huge. This is a move all the way from 29.83 down to 29.11. Okay. Then after actually checking the box at 29.11, we came all the way back up, just shy again of the gravity point, all the way back down to it. Okay. And then ripped, touched it. By the way, that's to the point, and then close the marketplace on the day. It's been like this, and I just want to show you, day in and day out. Break down to the time frame from 1 day. Let's just go back, look at the last 4 days, all the way in a 1 minute. Okay, and you'll actually see, okay, throughout the course of the week, us pinging on gravity points, okay, above and below it. And it is absolutely uncanny. It has paved the way for us. If you're not using these, yeah, get in the mood and get in the mood right now because they are, okay, really the path forward for you to be able to trade as we break off the gravity points and so forth. And that's something that we'll mention extensively here on TheoTrade while we're trading during the day. Now, moving on, okay, from gravity points, which again have been phenomenal for us this week. Next, well, we told you to watch the XLF. Well, are you watching? Are you listening? What do we say about the XLF day in and day out? This is the marketplace to watch, okay? Because if the XLF breaks down it is going to pull the S&Ps along with it. Now, the S&Ps, ironically, on the week, have actually ended ever so slightly higher. In fact, it's a little bit more confusing to look, I think, at the S&Ps to see that here. But let's actually go look at the SPX, the mother of all products. You have to recognize this week started right here. Okay, that's where the week started, and we ended, for the most part, let's call it a wash. Okay, this week ended, for the most part, massively unchanged, negligibly higher. Okay, and we'll come back to the expected moves here in just a moment. Okay, but the reason that we're keying into the financials is it has changed the nature of the entire marketplace under the 2650 level. And we are most definitively now under the 2650 level. Okay, the S&Ps at that point are just downright bearish. To me, watching the XLF under 2650, to me, it actually opens up a hole inside of the S&Ps. And I'm going to bring up the spiders and just say, listen, okay, at this point in time, all right, this door is wide open to the downside. And that's what you have to look at and recognize as a trader. You know, you always think about like risk reward, but when you're in the midst of like some fairly extreme volatility, risk reward is really, really hard to kind of judge. So what you have to do is you have to use different sectors that are really going to have big influence on the markets. And there's no question. Can we have a rip and bounce back in the XLF? Yeah, but 2650 ain't just a hop, skip, and a jump away. It's $1 away right now. Okay, speaking of 2650, okay, that marquee level, I mean, talk about skirting the line of 2650. The marketplace hung onto it, okay, like it was grim death before snap, and the S&Ps actually headed a considerable bit lower from that point forward. Now, with the XLF, obviously there's going to be influence there from the bonds. Time out for a second, the bonds. This is one where, you know, you see things during your career in trading, okay? And you could probably come in here every single day and probably say, I've never seen that before. I've never seen that before. People, I've never seen this before. But this isn't like AMD. This isn't Tesla, you know, okay? This isn't some pot stock that flew to the upside, right? And I had to show Tesla because the chart almost looks the same. People, this is the U.S. Treasury market. And you know that there's issues afoot when the U.S. Treasury market, okay, you're talking about a 2.6% move, okay? Speaking of which, with the Treasury market, I came in this morning to trade. Here we are on a Friday afternoon. I came in this morning and I actually said to the entire group here at TheoTrade, over 4,000 people, okay, logged on. And I said to the entire group, I go, I've never seen the bonds do this before. So what's the first thing that I did? I just went out and shorted them. Okay. Why did I short them? I don't know. I've never seen them do that before. Okay. What was the reasoning for shorting them? Because I've never seen them do that before. So here we are, just a few minutes, about 4 minutes to go to the cash open. We sold some bonds. Okay. Why did I do it? They were trading almost 178. Okay. I really like the idea of selling them at 179 and 21 ticks. And is it smart to short the bonds right now? You know what? This is, again, where we come to risk reward. And in this kind of volatility with this kind of an up move, I'm comfortable with it because I want you to take a look at the TNX. The TNX now is the 10-year. This thing had an outright crash to the downside. Now, my number inside of the TNX, okay, was 0.88. I want to remind you guys, because I've been saying that for quite some time, I figured that little monkey would come down to 0.88. Okay, I figured that would kind of be the final resting place for the TNX, but it exceeded it. So why did I short the bonds? Because we're below that 0.88. By the way, 0.88 is associated with somewhere right between like 136, 137 inside of the ZM. So again, the reaction in here is just shocking. Rates have absolutely crashed, which is going to bring me, okay, to another couple of points, which I'm going to come back to bonds and rates here in a moment. Speaking of which, I did do a trade on the TLT today. I took a little bit of a shot and put on a wicked ratio back spread here, where I'm actually selling the 165s and buying 2 of the 156s. Okay, if you want to see it in terms of the risk graph, come in here and hide the positions and show you specifically on the risk graph. But here's a trade again. All I did was put on a big, huge, it's just a back spread. Okay, and the reason I used a back spread is because the implied volatility of the option I was selling, which is the 165, is about 28%. The option I was buying, and I'm buying two of them, was about 27.67. So I felt the implied volatility skew was in my favor. But the reality of this, these bonds got to come down a lot. They got to come down to like 150 to make me even crack a smile. For me, worst case scenario, they got to be like below 147. Now you ask yourself, could they be down all the way back here at 150? Could they be at 145? I'll remind you, I used May. I got 70 days. See you in 70 days. We'll see if this thing actually pulls back. Those back spreads, they can be wicked. There's a lot of margin tied up in here. They can be wicked, but oh boy, could there be profitability in there. All right. Next, get ready for bailouts. I just wanted a quick mention of this one because I think it's come up a lot lately. Let's say get ready for bailouts. Anything travel related, airlines, okay, the coronavirus, it's crushing their will to live. I mean, when you start to look at things like American Airlines, now American Airlines, it did have a little bit of a bounce today and then faded off of its own bounce. I look at American Airlines. All right, listen, you can open this up on a 3-year. You can open this up on a 10-year. Nothing has been as serious, okay, for the industry since obviously you have to go back to 2008, but you can even go back to September 11th, right? But nothing has been as serious for the travel and travel-related industry as what we're seeing right now. Now, within this group, you also have to look at United Airlines. Okay, the problem with United Airlines, I don't think the stock's down nearly far enough just yet. I think the impact to this could be absolutely devastating. But I'm telling you right now, get ready for bailouts. And the reason I'm mentioning that is because people are going to look at things like United Airlines. They're going to think to themselves, I could short this into an oblivion. Okay, I would think again with the airline stocks, I think it's dangerous. Anything travel related could be dangerous to be short because again, they will come forward with bailouts. Now, things like XOP. What is XOP? It's oil and gas. Are there going to be bailouts in here? Probably not. But I would argue that there's going to be mass consolidation in the energy industry as a whole. Again, mass consolidation. Why, you ask? Oh, their sector. Just this is on a year-to-date basis. It's down about 45%. If you're not into XOP, here I think that bounce trades are totally in play. But I've actually tried a couple of bounce trades, both in XLE and in XOP, and as of right now, I'm wrong. Okay, I think that they're going to be decent buys, but you're going to have to step in here, and I'm going to tell you, you're going to feel the fear. Okay, if you go out there, I sold a couple of naked puts. You know why I sold naked puts? Because I don't mind buying the stock. And I don't mind buying the stock. I'll buy all the XOP I can get my hands on, right? But I'm going to sell puts to be able to do that, to give myself a little bit of a discount to get into a couple of those positions. The reason I'm mentioning the bailouts, there are certain areas that I'm going to avoid and certain areas I'm going to go after. If you're thinking about like shorting airlines, again, I would be cautious. And on that front, okay, I'm looking at a long position right now inside of energy. If there's something left to short, people are going to talk about, the different cruise lines and so forth. They're hideous out there. Okay, if there's something left to short, well, I've got positions in this like Las Vegas Sands, okay, the casino stocks. And I'm bringing up the casino stocks because if you think about bailouts, I think there's moral hazard here. I don't think they're necessarily going to bail out of Las Vegas Sands, okay, no matter how long they may actually close some of these casinos. It's not just Las Vegas Sands. It's going to be, Sands. It's going to be MGM. All right. It's going to be all of them. And again, you can see MGM is still technically outperforming versus what it was doing back in 2008 and 2009. Nevertheless, it is definitely a dent into this particular underlying year-to-date percentage. It's down about 40%. Got to be careful at this point in time, though. Okay, in the casino stocks, I'm still looking for these things to bounce, and then I may short them again, okay? Whereas in the airlines, I am not going to be caught short those airlines. Again, get ready for some bailouts. All right, next up on the plate. Where's the bottom? Where is the bottom? Okay? To me, and I'm going to look at this as objectively as I possibly can, I'm bothered by where the S&Ps happen to be right now. All right. And I'm going to bring up the S&Ps once again. I'm bothered by where the S&Ps happen to be because to me, it's, as just kids, we used to play that, what is wrong with this picture? And you find like 50 different things inside there. The kid's got a hat on backwards, except his head is actually upside down. The market looks like that right now. There are things that are going on right now in the marketplace that just don't make a lot of sense. And I'm going to take you through a couple of them. Okay. When I say where's the bottom? All right. We all know that volatility is really, really high. I could talk about the VIX till we're pretty much blue in the face, right? Today, this is pretty much our closing high of the VIX. And at that 41, 42 level, okay, standard deviation says, we're like, 3 deviations, almost 4 deviations out on the VIX. But I'm going to tell you what's wrong with it. Yes, the volatility is high, and volatility being high can absolutely be a sign of a bottom, okay? But then I'm also going to look at the VVIX. That's the volatility of the volatility index. What doesn't make a lot of sense to me is that professional trade is still buying volatility, okay, in the volatility index. Yeah, that one really does. It gets to me, okay, because I've seen the onset of volatility in the past. Like, this ain't the first rodeo I've been through. I've seen the onset of volatility, but what I can't for the life of me understand, usually the initial shock is felt, okay, and then the volatility of the VIX itself contracts. In this case, it's amplifying. So what it's saying right now, and put this in common terms, you have professional trade buying volatility in the VIX right now. That doesn't make me feel warm and fuzzy. On top of it, professional trade evidently is going to the bonds. Okay, this isn't just a bunch of monkeys going for the bonds. This is sovereignties. There's no question. There are other countries coming in and buying U.S. bonds. All right, it's just a total bond fest. Why did I short the bonds? I think eventually it'll cool off over here. But the picture that this paints is not necessarily a pretty one. Okay, because basically what they're saying by buying these bonds, we'll do anything. We're a bunch of just yield-starved, wild animals out there. But I actually will argue this. The bond buying isn't just about driving yields lower. Okay, it's not about the Fed. This is actually momentum-driven algorithms. Okay, what I'll actually argue all day long is that what you're seeing in the bond market, okay, isn't just a bond bubble. It's momentum driven. They're trading the bonds like they're trading Apple, like they're trading AMD. Okay. And they're actually diving into the bonds, not as duck and cover. They're diving into the bonds, okay, because they want to buy bonds, right? And all throughout the course of the night, they actually want to buy the bonds because the bonds are having upward momentum. Great. They're buying bonds, selling stocks. It's a party out there. The divergence grows. You make a bunch of money. So the bonds, all right, yeah, we know volatility is really high in the bonds, but they're definitely making us nervous. And they should make you nervous as well. Because if the bonds keep flying like this, anything is plausible. Now, the volatility futures, let's go back to this. What also doesn't make a whole lot of sense, if you look at the S&Ps kind of saw their bottom here. Let's call it mark it on your screen. And I'm going to use the spiders in this case right over here. Okay, let's call it 285. So we're north of that right now, and we're a lot north of it. Yeah, we're almost $15 north of that in the spiders, which is a hop, skip, and a jump in this kind of volatility. So we're north of that, though. And the thing with the volatility futures, again, that kind of gets me at this point is why are the volatility futures at their highs? They're at their highs. In fact, when people talk about contango and backwardation, bottom line, volatility futures are more inverted now than they were last week when we saw some of the lows. I'm bothered by it. I'm bothered by it because it does not paint a good picture moving forward for the S&Ps. It looks like the S&Ps, the bottom needs to drop out. Gold also points to this. Okay, gold continues actually to vault a little bit higher. Now, when there is liquidation selling, gold will probably drop. But at this point, as long as gold continues to amplify higher and continues to track a little bit higher, it leaves us nervous. Every one of these risk assets leaves me nervous. Last but not least, which I already pointed out, was the financials. The financials being under 2650, it just says doors open right now. Doors open to go lower. Gold's pointing toward. The volatility futures are pointing toward. Bonds I'll call the odd one out because I think they're just trading them to the upside. But the VIX and the VVIX are also pointing to it. All right, a couple other points over here. The Fed. The Fed is intent on saving the world. You got to love this. The Fed saving the world from infection. That makes me feel warm and fuzzy. But this, to me, this is the inflection point we've been waiting for years, okay? And I've talked about this pretty much ad nauseum. And by the way, if you missed like last weekend's update, you missed it. Okay, you missed it all because we talked about pretty much what was going to happen. In fact, this is some of the bullets from last week. But I was talking about last week is the Fed. Okay, it didn't surprise us that the Fed came out and did a surprise rate cut. There was no surprise to the rate cut that they did. It was just untimely, I believe. Okay, so the Fed comes out, does a surprise rate cut. And when I say this is what we've been waiting for years, this is an inflection point that we have been waiting for years. I believe that the marketplace is going to start to turn their back on central bankers. Okay, and that we're on the verge of seeing some of that right now. And what that means, and again, I specifically talked about this where the Fed comes out and cuts, okay, in an emergency fashion and the market sells off. This week we stabilized a little bit, okay, but the marketplace cannot be saved, all right, from a Fed. They're going to go out. They're going to even possibly inject liquidity, okay? They could even go out and buy stocks. But they're actually what? They're just inducing at this point, I believe, more fear. And at some point, the marketplace will start to recognize the Fed can't be their savior, okay? And I think we're seeing some of that, again, in these risk assets. And that's exactly why I wanted to mention a little bit. Nevertheless, the Fed, we're 2 weeks away, well, less than 2 weeks away now from another Fed announcement. And the Fed, they're priced in right now to do another major cut. Again, another major cut is coming to a theater near you in just about 2 weeks, if we make it another 2 weeks. Last, but definitely not least, the SPX expected move. Last week, let's actually cruise to it. Last week, the expected move inside of the SPX, a whopping $182.29. This next week forward, almost $162. Where do I actually derive that from? Go to the SPX. Today was a $51 move to the downside. Go approximately 7 days out. There you are. Okay, you're looking an expected move again of $162, almost on par with what you saw last week. But the point of me saying this, okay, is that, again, there's a very, very mild contraction of volatility from like this previous week to the next week, okay? But what you have to understand about these massive expected moves, as long as the expected move, okay, is this wide, it just lends itself, the marketplace can completely free flow, all right, in this standard deviation. That's what the expected move is. Okay, it's nothing more than a standard deviation. So when you're looking at this expected move and you're trying to interpret it, okay, it's just a deviation flipped on its side. And you look at it and we're saying like, yeah, we can go up 162 or down 162, okay? And we're going to make every effort and every ounce of that move count in this next week of trade. Again, another week coming. And expect more volatility. We're coming into the third week of volatility. Now we'd anticipate markets get tired, just like traders get tired. You've just passed through 2 weeks of volatility. You having fun yet? No, you're probably exhausted. But it's about P&L. If you could survive the risk, you're going to be able to make money in the risk. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.